G'day and kia ora everyone. My name is Sanjeev and welcome to the Engineered Investments channel. At the end of this video, you would have gained objective insights into Fisher Paykel Healthcare, a healthcare listed company on the Australian Stock Exchange. Looking at the establishment metrics, Fisher Paykel was established in New Zealand in 1934, initially as an appliance dealer, then later as an appliance manufacturer. Here's a fun fact. According to the website, when the New Zealand government banned imports of manufactured products, a few years after Maurice Paykel and brother-in-law Will Fisher started the business, they responded by establishing a factory to manufacture in-country. In 1969, or 52 years ago, they expanded into the healthcare market through their developments and innovation in respiratory care. Having divested the appliance business in 2004, today they solely operate in the healthcare market, focusing on designing and manufacturing products and systems for the use in respiratory care, surgery, and obstructive sleep apnea. Headquartered out of Auckland, Fisher & Paykel Healthcare provide their devices and solutions into the hospitals and home care markets. They employ roughly 6,900 people across 45 countries, including regions like Europe, North America, South America, Asia, and of course, New Zealand and Australia. They currently rank 25 out of the 2,200 plus companies in the Australian Stock Exchange and rank number 1 on the New Zealand Stock Exchange. Yes, they are a dual listed company. Just a heads up, the figures are shown in Australian dollars rather than New Zealand dollars. Looking at the front metrics, dividends have been paid continuously over the last 5 years. In addition to this, there's also been a steady increase in dividend payouts during this exact same time frame. The share price has grown by 235.8% over the last 5 years. So if you had purchased the shares in September 2016 for $9.57, as of August 2021, your share price would have increased by this percentage to $32.14. The 2021 revenues increased from the previous year by $550 million to $1.79 billion. Fisher & Paykel Healthcare outlined this increase was underpinned by an extraordinary growth in the hospital products, which had increased output roughly 6 times. Their home care products also saw growth overall that positively contributed to this year's results as well. The company has mentioned, however, they will not provide guidance into the 2022 financial year due to uncertainties in vaccinations, lockdowns, and COVID-19 variants, which are all contributing to higher than normal hospitalization rates. The company expects their hospitals and home care products to be impacted by these uncertainties. In simple terms, this year's financial numbers might return to normal or could remain spiked for a bit longer. The earnings before interest and tax increased by roughly $300 million to $662.5 million. The profits before tax landed in at $659.3 million, an increase of roughly $300 million from the previous year, and more than twice that of 2 years ago, which, based on the company's commentary on the revenues, is due to the higher than normal hospitalization rates that are increasing demand for the hospital products. Looking at the shareholder metrics, the return on equity ratio has increased to 34.5%, a 5% increase from the previous year, indicating healthy profits are being maintained from the assets owned. The debt to equity ratio has remained significantly tucked under 40%, a value we use as a rule of thumb for manufacturing type healthcare companies, to ensure shareholder equity is not likely to be impacted if the debt repayments were to drift upwards. The earnings before interest and tax margin, or EBIT, has increased significantly, adding another positive dimension when attempting to gauge profitability versus the pre and post tax profits. The gross margin decreased by 2.9% to 63.2%, the company mentioning that the increased freight costs and high air freight utilization adversely impacted constant currency gross margins. Profit after tax, or take-home pay, has increased by $201 million, just over 1.7 times when compared to the previous year. A nice result in capitalizing on the global healthcare situation. So what's the outlook? Put simply, Fisher Paykel's Healthcare was positioned at the right place at the right time to respond to the global healthcare concerns, resulting in a year like no other, showing an accelerated business performance during this type of global market disturbance. Whilst no 2022 forecast was given, we can probably read between the lines that the results are extraordinary. However, we can also work out when things do level out, the company has put in place initiatives to maintain normalized year-on-year growth. Example, Examples of initiatives from the financial report were the introduction of new products into China, Brazil, and Spain, as well as placing their own sales representatives into another 5 countries to build direct presence, stronger customer relationships, and a better understanding of changing clinical practices. In summary, dividends have been continuously paid over the last 5 years, and the share price has shown strong growth during the same time frame. The front metrics are good but spiked, as we discussed the reasons earlier, with a $550 million increase in revenues from the previous year and a slightly more than doubling of pre-tax profits from 2 years ago. The shareholder metrics are suggesting excellent profits are being extracted using the shareholders' equity, in addition to ensuring a healthy take-home pay now and when the dust settles in the short term to mid-term. These characteristics typically signal a high potential for stock investment. This brings us to the end of the video. Please do like and subscribe. Thank you for watching. See you next time. Ka kite ano.